Hello, everybody. Welcome to another episode of Ask the Joorney Expert with me, Matt Wolf. Today, we're going to be discussing the difference between a financial model and financial projections. Now, keep in mind, this demonstration is simply to show the differences between the two, the advantages of a financial model for your business or venture. It's not to demonstrate how to do financial modeling or necessarily even the values that are in the cells. It's simply to show the advantages and disadvantages of modeling versus financial projections. So let's start. So we're going to cover 5 topics showing the differences between a financial model and financial projections. First one, scenario analysis. Basically, a financial model enables you to see in real time what happens to the projected financial statements when inputs, such as the price of your product or service, change up or down. So this is a basic financial model. It is a stripped down model of an imaginary events business. It's only one revenue stream, and that is events. You'll see here in this model several tabs: assumptions, calculations, and financials. For this demonstration, I have put 2 instances of the same file side by side to show why a financial model is dynamic and what happens when you change one input and how that affects the financial statements. So here on the right side, these are the financial statements. You have a profit and loss, balance sheet, cash flow statement here. And you have all the dynamics of how this all flows through by month, going all the way through, and then eventually going into year 2, 3, 4, and 5. So let's just consolidate this as so, and let's start changing what some of these prices are going to be and how that affects the financial statements here. So let's say, as an example, it's not going to be $5,000 for the average size event in year 1. Let's say it's $4,000. You can see how it affected the year 1 financial statements here in the profit and loss. Now let's say we want to increase it to $6,000. Then obviously that makes the output look a little bit better in the first year. For financial projections, in order to execute the same amount of dynamic ability, they would have to be changed each time to view the changes in price to the product or service. Makes it much more cumbersome and much less efficient. Second point, the revenue model. In a financial model, it allows you to tinker with the inner mechanics of how the company plans to actually generate future sales. So in this financial model, we have it basically set up so that the revenue model is based on the number of salespeople that are currently employed with the company. Each salesperson has a target, a monthly target of sales that they need to meet. The assumption here is 2. So for each sales associate that we have, we're projecting that they're going to sell 2 events. So what happens to sales and the financial statements if we change the monthly sales target to 1? And you can see how the sales decreased here radically. Let's say we changed, instead of the monthly sales target, but the actual number of salespeople that the company has employed. So right here, instead of 3 in the beginning, we make it 1. And that changes the financial statements here in year 1. So you can see how the inner workings of the actual revenue model are manifested in the financial statements. In financial projections, it only allows for static inputs to be inserted into future years. And it doesn't have that dynamism that is available in a financial model. Determining the size of investment. Financial model allows the real-time viewing of experimenting and ultimately determining the appropriate size of the investment that's going to be required. So here we're going to assume an equity investment of $400,000 for this business, as shown right here in the Assumptions tab. So let's take a look at the financial statements on the right side of the screen. As we go down here, after the cash flow statement, we've got some dashboard mechanics of lowest closing balance and valuation, post-money valuation, investor shareholding. So how do we know that $400,000 is the right amount to be asking for equity? Well, if we look here, it says the lowest closing balance is $59,641. If you ask for an amount that's too low, let's put in, for example, $200,000, you'll see that the lowest closing balance, this is the cash balance at the end of a certain period in the model, actually dips below zero. That means this business has run out of money and is no longer viable. So that's not going to work. Let's bring this up to 600,000. Now let's bring this up to $600,000. The lowest closing balance is now $259,000. So there's a nice buffer of cash there in the event that maybe some of the sales targets aren't met, you don't hire a sufficient number of salespeople, or what have you. The issue is, if you're asking for money, that's certainly going to affect valuation, which obviously also affects the investor shareholding, which now shows it at 34%. If we go back to the assumptions and we put in the original equity amount, $400,000, you'll see how the investor shareholding has changed to 22%, which is a typical average amount per round of funding between 15 and 25%. And you're back at your lowest closing balance of $59,641, which is above zero and could be sufficient enough to go forward. Valuation movements. With a financial model, you can quickly see how valuation changes in response to other input changes. This allows you to make sure you're in the right valuation range given the stage that your venture is at. So if we keep an eye over here on the right side of the screen, we see post-money valuation, $1.784877 million. What happens to this post-money valuation if we change some of the inputs on the Assumptions tab? Say, for example, instead of the monthly sales target per salesperson at 2, let's say it's now 1. The post-money valuation is now $464,926, which results in an investor shareholding of having to be about 86%, which is probably not going to work. In addition to that, you're now below zero on your lowest closing balance. So this is a good example of how everything is interconnected in a financial model and how all of it is dynamic, simply with the change of one input, and how all of that changes the financial statements, the closing balance, the valuation, the investor shareholding. In financial projections, valuation would need to be performed each time the projections are redone to view a new scenario. Again, very inefficient, takes much longer time, and is quite cumbersome. It's not well suited for valuation purposes. And the fifth topic, incoming investor shareholding, which we've touched on a little bit already. In a financial model, it shows in real time how changes in free cash flow affect the incoming investor shareholding and allows to efficiently adjust to hone in on the typical 15% to 25% of shares to sell per round of funding. So just going back to the assumptions tab here, and also taking a look here at the original investor shareholding at 22%. Let's see what happens when we change year 2 average size event. Instead of $8,000, let's put it at $4,000. You can see how the investor shareholding ticked up a little bit. Also, the closing balance is below zero. So these assumptions are not going to work as is. You're either going to need to raise more money or you're going to have to increase sales in some way. The financial model enables us to see this in real time. Whereas in financial projections, you cannot really easily see the viewing of the incoming shareholding based on the free cash flow formulations. So that was a short webinar simply to illustrate the differences between a financial model and financial projections. To keep in mind, financial projections are static. They're simply a snapshot of a view into the future. It doesn't show the mechanics of how the different elements of the business are put together in numbers. Whereas a financial model shows the financial and numerical representations of the business into the future. It's much more dynamic. It is not static like financial projections, and is a great tool to really viewing a variety of different scenarios, different prices of your products or services, different numbers of staff, different salaries, all in real time. And it's a very powerful tool for entrepreneurs to use because of it.